what we're going to be going over here is governmental accounting for bond issues. And we're going to be looking at bonds issued at a premium versus being issued at a discount. And we'll also look at serial versus term bonds for this bond issue. So this is what we're going to do here. For our example here, city or municipality is going to issue some bonds to finance some capital projects. So what this is going to include here, or what it's going to involve for this bond issues, is under our governmental funds, it's going to include the capital projects fund here for the issuing of those bonds here. And along with that, we're going to have the debt service fund here. The debt service fund is a fund group here, and this is where we're going to service the debt here for that bond issue. And along with our governmental funds here, then we have to have our accounting control groups, where we'd have our general fixed assets and also our general long-term obligations. And for our example here, we're going to be looking at general long-term debt here for this bond issue. So that's what we have to deal with, looking at our funds here versus our accounting control groups here. Okay. So first, let's go look at bonds issued at a premium here. So what's going to happen here? They're going to issue these bonds, $700,000 worth of bonds here, and they're going to receive $735,000 for they issued the bonds here. So we're going to have a $35,000 premium here on this bond issue. So first, what we have to do here is we have to make the recording here in our capital projects fund for the bond issue here. And along with that, we're going to have to, at the same time, we're going to have to record here under our debt service fund here in the general long-term debt account group here, also that bond issue. Okay, so starting with our capital projects fund, we would have our cash account here, and then I'm showing out in T account form here, and what we have to be concerned about is the titles here under each of our account groups here. When you're dealing with governmental accounting, be concerned with your titles here. So under our cash accounts, this would be in our capital projects fund here. We're going to debit it here for $735,000. That is the bond proceeds that we received, the bond face amount plus the premium amount here. Debit it for $735,000, and then the credit here is going to go to other financing sources control account here for our capital projects fund here. So credit it for $735,000. So that's for the bond issue here. What we're going to have to do, this $35,000, it's going to be transferred to the premium. We're going to transfer the premium to the debt service fund later here. But we're just making our initial entries here. Okay, and then again, moving down to our debts, our general long-term debt account group here. This is where we're going to have our account here, a amount to be provided for the payment here of this long-term debt here in our long-term debt account group here. So we would debit that here for $700,000. That's what we're going to have to pay, principal amount here on that bond. So, and then moving over to our, then we'd set up here our credit amount goes to the bonds payable, again under the general long-term debt account group. Credit that here for $700,000. So what we're doing here in our general long-term debt account group, we're recording our debt here at its face value, the face value of the bond that's being issued here. In the capital projects fund, we're recording it based on the proceeds we received. In this case, it was a premium, so we recorded the bond here, the proceeds, the total with the premium amount included. But in our general long-term debt account group, we just recorded here at the face value. So what we're looking at in our general long-term debt account group here is really the unmatured principal of this debt or this obligation. And again, we're going to look later here where the premium, actually we would have to make some entries into the general long-term debt account group to remove this premium. It's going to be removed later here, but for now we just have to debit it here, look at the amount to be provided for the payment here, debit amount of the face value of $700,000, and then the bonds payable, the credit here, the setting up our liability for $700,000. And for our example, we're just the $700,000 here for a reference. They're going to be a 5-year bonds, and they're going to pay 12% for the serial bonds here. Same for the term bonds here, but with the serial bonds, you're going to have the semi-annual interest payment here plus semi-annual principal payments. Where the term bonds, the principal amount is just going to be, total principal amount is $700,000 is going to be paid at maturity. Okay, so that's what we have to do here for our bonds issued at a premium. Now moving up over here. Now, just say for example the bonds are issued at a discount. So again, Capital Projects Fund, we're going to issue $700,000 worth of bonds for $690,000. So we're going to have a discount amount here of $10,000. Okay, same thing here. So when you're looking at issued at a discount, again, you have your Capital Projects Fund here, the cash amount under Capital Projects Fund, debit that here for $690,000, the actual bond proceeds. And then over our credit is going to go to other financing sources, control account here, credit that here for $690,000. So here, again, bond proceeds for the bond issued. Now, at the same time, we're going to make a recording here under our debt service fund in the general long-term debt account group. Again, amount to be provided for the payment here of this long-term debt here. Debit it for $700,000. That's the face value of the bond. That's the principal or the maturity here that's going to have to be paid on that bond. And then the credit is going to bonds payable for the under the general long-term debt account group. Credit that here for $700,000. Okay, so you're seeing what's going on here with the discount. Again, under your capital projects, just take your cash, debit it for the actual amount received here, and the other financing sources, again, for the actual amount received here for the bond issue. Whereas general long-term debt account group, same as issuing at a premium, you put it down at its maturity value. Okay, so we talked about the premium amount where we're going to have to transfer out the premium here to the debt service fund, but with the bonds issued at a discount here, you can actually stop here. There's not going to be any further entries here except for the interest, semi-annual interest and principal payments here. You can stop because the question you have to ask is, did they raise enough money here by this bond issue? And if not, you will need another financing source. So the discount amount here is going to have no effect here on our general long-term debt account group when we start recording the unmatured principal for this debt. Okay, so let's just to review here again, just for a reference here, the Capital Projects Fund, that accounts for resources used in the construction here, and again, that's that resources as that bond issue we have. And then our debt service fund, that's going to accumulate the dollars to pay off the debt or this bond here. And then in our general long-term debt account group, that's really going to account for the unmatured principal of, in this case, the debt here. So next thing we're going to go and look at is the interfund entries for taking care of that bond premium. Discount, we're not going to have to deal with we don't have to deal with a premium here. Bonds issued at a discount, when we're talking about bonds issued at a premium, then we have to make we're going to have to make some interfund entries. All right, so we'll move on to the next slide here. Okay, now let's look at our interfund entries for the bond premium. So when we issued the bonds here, we received $735,000 in proceeds. They have a $700,000 par value or maturity value here. So the difference gives us a $35,000 premium amount. So these interfund entries is really a three-step process. So what we're doing here is with this premium here in our capital projects fund, we're going to be transferring that cash premium out of the capital projects fund, and it's going to be transferred into the cash account here in the debt service fund. Debt service fund is where we're going to accumulate the funding. And then we're going to be looking also at the general long-term debt account group to make sure our unmatured principal is correct. Okay, so starting out with our capital projects fund here in step one, this is where you're going to set up your uses control account. So if you would have to set up account here, other financing uses control account. So what you do here in your cash account, you're going to reduce it or credit your cash here by $35,000 for that premium amount here, and then you're going to be debiting the other financing uses control account here in your capital projects fund here for $35,000. And essentially you're just taking this cash account again out of the capital projects fund, and you're going to be moving it down into the debt service fund. But you have to go through these intermediary accounts here. All right, so now let's look at step 2, where we're actually going to make the transfer of the bond premium dollars here from the capital project fund to the debt service fund. So in your debt service fund, you're going to set up this account here, other financing sources control account. And this is where you're going to credit it here for that bond premium here of $35,000. Along with that, the debit is going to go to increase your cash here for $35,000. So what we've done here, again, just taken our cash out of our capital projects fund here and brought it into the cash account here in our debt service fund, but we did it through these uses and sources accounts here. Other financing uses control, we would have debited it here again in our capital projects fund for $35,000, and then the credit here would go to other financing sources here for $35,000. So you see what's going on here. We had to use those intermediary accounts here, but in the fund groups themselves, you take for the capital projects, you would have credited here for the amount of that premium, reduce your cash account for that premium here, and the debit goes to other financing uses here. We're using it here, debited it here for $35,000. And then in our debt service fund, we had that other financing sources for that premium amount. We would have credited here for $35,000, and then the debit went to increase our cash here for $35,000. Okay, so just so you understand what's going on here. Okay, so now let's look at step 3 here. This is not a transfer here, but it's an entry in our general long-term debt account group to make sure our unmatured principal obligation or debt is correct, or carrying value here. And when we're talking about general long-term debt account group, there's only really 3 accounts in that group here that carry debt, and we carry it at its unmatured amount here. And those accounts would be, and let's look at them here. You have to have before we had that amount to be provided here for payment for the long-term debt when we issued that bond, and then we had our bonds payable here again for the long-term debt account in a long-term debt account group here. So when we issued the debt here, the amount to be provided, we had it at $700,000, and then our liability we set up here, credit amount here for $700,000. But what we're doing here, we're just looking at it requires an entry here in the general long-term debt account group here. So for that premium amount here, we would have credited or reduced our amount to be provided here by $35,000, and then the debit amount would go to the amount to be available here for the payment here of that long-term debt. Debited it here for $35,000. That's the amount available. So if you just match up your accounts here, the amount to be provided for the payment here, that credit of $35,000 here, sort of matches up with our debt service fund here, the debit amount here, that cash of $35,000. And then looking at the amount available for the payment here, the debit amount here of $35,000 sort of matches up with the other financing sources control, a credit here of $35,000. But remember here in our step 3, there's really no transfer of any dollars. It's only to make sure that our general long-term debt account group has the correct unmatured principal amount for the obligation. So started here, we should just have these $700,000 sitting here in our unmatured principal. Okay, so next we're going to be looking at the entries here for those semi-annual interest and principal payments. Now let's look at our semi-annual interest and principal payments, and we'll start with our serial bonds here. So we've had a $700,000 par value on those bonds. They are for 5 years, and they pay 12% interest per year here. So for our semi-annual interest payments, of course, we'd have the $700,000 here times 6% interest here for $42,000 here semi-annually interest payments, and then the principal amounts, they're paid out again semi-annually here for that total amount of principal here. So we take the $700,000 total amount over 5 years. Well, that would give us 10 semi-annual payments here. Divide that into 700,000, and you're going to get 70,000 here for the principal payments. Okay, so first let's look at recording that semi-annual interest here on those bonds that we issued. And again, this is going to be in our debt service fund here. So what you're going to do here, you're going to have to set up this account, matured interest payable. So that's the key here. Set your account up, matured interest payable, again in your debt service fund. And what we do for that first payment here that we're going to make, that $42,000. We'd credit our matured interest payable here for $42,000, and then along with that, the debit would go to our expenses or expenditures control here for $42,000. But what you want to note here, when your governments do not record or accrue interest or principal until it's matured, due, and payable. So that's the key account here. This $42,000 was matured, due, and payable, and we couldn't accrue it here as an expense until those it was met here. These three requirements were met here. It's matured, it's due, and it's payable. Okay, so when it was payable, when we actually sent out the payments, that's when we would debit or reduce our matured interest payable here by $42,000, and then the credit would go to reducing our cash account here for $42,000. And then one other thing I want to point out here, when a government issues bonds here, there might be some issue costs involved here, and those issue costs would be expensed the first year. So assuming that we had $10,000 worth of issue costs here on those bonds, we would debit or increase our expenses by $10,000 here for the issue costs, and then the credit would go to reducing our cash account here for $10,000. Okay, so now let's go down again. Recording our serial bonds redeemed is in a series here, those series of 10 semi-annual payments for this 5-year bond. So this is where it involves both the principal here and our interest on a semi-annual basis. Again, we're going to be using modified accrual. So what you want to do here, we've already went through the matured interest payable. We already looked at that up above. But also included here, when you're dealing with those serial bonds here, you're going to also have the matured bonds payable, that $70,000 here. When we looked at it up above here, where we didn't include the matured bonds payable, that would have been just for term bonds here. Term bonds where we pay just the interest. But when we're dealing with the serial bonds, we have to deal with both the principal and interest payments. So for let's look at our principal payment here. You would title that matured bonds payable here, and in this case we would credit it here for $70,000. And then what we would do here, we would when it's actually paid out here, you would debit it here for $70,000. And what we want to look at here is both our cash and our expenses. So we have to add in those interest payments here that we looked up at above here. That was that what? That was that $700,000 times that 6% semi-annual interest here for $42,000. And that would have given us $42,000 here in interest payable. And then remember that matured bonds payable, or that principal amount, was over those 10 semi-annual periods here for the 5-year bonds. That $700,000 amount, that was for the $70,000. Okay, so what you would do here, you just you take your payables here, the matured bonds payable and the matured, and that was for the principal amount here, and then your matured interest payable, that was for the interest amount. You sum those amounts up here, and that is what's going to give you your expenses here, both for the interest and principal on their serial bonds. So total of $70,000 here plus $42,000 gives you an expense here of $112,000 that we're recognizing here. Again, a modified accrual basis. And then our cash account here, well, that was just when we actually reduced our payable here by making that payment here. $70,000 for the bond principal here, plus $42,000 for the interest payment here, gives us $112,000 here in our cash account that we had to reduce. So the question is, where does this money come from? And we'll go over that briefly here. What we're doing here, it has to come through accumulating some funding here in your debt service account, or debt service fund, excuse me. Okay, so now let's go up and let's just look at term bonds here. This is where the total face value is due at maturity, and you would only be recording your semi-annual interest payment, and the total matured value here, or the principal amount, would be paid at the end. Okay, so looking at, let's just say we're looking at when we actually interest when it matures here at the end here, and we're going to have both look at the principal amount here, that total principal amount, plus an interest payment. So interest payment, that was what we calculated, $700,000 times that 6% semi-annually. that was for the $42,000. So we would have recorded that here as matured interest payable, again, in the debt service fund. And then for the matured bonds payable, well, that was the total matured value here when they mature at $700,000. So just looking at our, again, expenditures here, we recognize both the principal and that final interest payment here. Total amount here, $742,000 for expenses here. That was the $700,000 for the total matured value of the bond when it's paid out at maturity here, this term bond, plus the interest payment for the period here, $42,000. And then, of course, the cash account would be credited here for those total amounts here, $742,000. Just remember, that would be credited here when you make your payables or you actually make your payments here. That total $700,000 would be debited to your matured bonds payable, and then the matured interest payable would be debited for $42,000. So again, where does this money come from here when we pay out in our debt service fund for those bonds? The maturity value, or the whatever the principal amount that's being paid, and the interest that's being paid each period here. Okay, so what you're going to do here, the debt service fund, this is where did the money come from? You're going to have transfers from other sources like the general fund and other funds here, transfers into your debt service fund, or you may have some special tax levies, or you could have some investment income. But just looking at our debits and credits here, so for transfers in, you would have, I got it off shifted here a little, your cash account. You would debit your cash account here, and then your credit would go to other financing sources here, and then for investment income, for example, you'd again increase your cash account here, and then you would credit credit your investment control account. So your debt service fund here accumulates the dollars here to pay off the debt. And then one other thing here, you can't forget here, when you're making those semi-annual interest payment or principal payments here, using those when we're talking about serial bonds, then under your debt service fund, you have to be concerned with your general long-term debt account group. This is very important. This is where you account for the unmatured principal of the debt. So looking at our first principal payment here when we're dealing with our serial bonds. So we had our amount to be provided for the payment. We debited that here for $700,000 when that bond was issued, and then our bonds payable, we had credited that here for $700,000. But when we made that first principal payment here, we would have debited or reduced our bonds payable by $70,000, and then our amount to be provided for the payment, we would have credited that here for $70,000. So remember, when we looked at those principal payments here in our debt service fund under the serial bonds, we have to keep track of it here in our general long-term debt account group here. We got to reduce our general long-term debt account here by those principal payments that are made, amount to be provided, and then our bonds payable, our liability. So we have to account for the unmatured principal of the debt. So we have to, in this case, for each of those payments, we would be reducing the amount to be provided by the principal payment, and also our bonds payable, reducing that. Okay, so that's a key item here. Of course, if it was just with the term bonds, then you'd have the total $700,000 here at the end for the principal amount that you would be amount to be provided. You'd be crediting that out here for $700,000 when they're actually matured, and same with bonds payable. You'd be crediting that out here for $700,000. But along with, just remember, in your debt service fund, you have to keep track under your debt service fund. You'd have this general long-term debt account group here, and that's where you have to keep track of the unmatured principal of this case of the debt. Okay, so that'll summarize our topic.